what I want to share first is just a little bit about myself, more in depth in terms of what I do and why I became a patient advocate specifically for long-term care claims and whatnot. And then the other thing that I want to share is that I'm assuming that some of you who are in attendance do have the CalPERS long-term care policy, and you may have some questions about the most recent mailing maybe that you received. So we're going to talk about that a little bit. And I understand that you can put in chat questions. And I just have a quick question. Will that be monitored for me? Will someone ask those questions after the webinar is over?
I can go ahead and ask them at the end.
Okay.
Do you prefer them at the end or as they come in?
You know, at the end would be great. Thank
Perfect.
you. Okay. So as my bio said, my husband and I started a long-term care insurance agency in 1987. So I've actually been in this business for a really, really long time and have seen just a ton of changes. I took a little bit of a off-ramp in the long-term care insurance market right around 2010 because my clients were starting to file claims on their policies. And I was helping them a little bit, but we kept running into the same problems over and over and over again with regard to people trying to get their benefits. And I will explain a little bit about why that's happening. But as a result of that, I changed my practice. I became a board certified patient advocate. And the majority of the work that we do right now, myself and I have 4 other staff members, we help our clients manage their long-term care claims and their benefits. We help them get care in their home or help them find a facility if that's what they want. And we just follow them as long as they need us to follow them just to make sure that everything's going okay. What this particular webinar is about is long-term care 101. And what that means basically is, what the heck is long-term care? Do I need a policy? If I do need a policy, what kind of a policy should I have? And again, I don't want to go super deep because a lot of times on these webinars, a good majority of people that are attending already have long-term care insurance. And so I want to keep the conversation relevant to what's going on. Some of you don't have long-term care insurance, and you should be able to tell after this program if it's something that might be of interest to you, and you're welcome to reach out to me. But for those of you who have long-term care insurance, I want to make this webinar such that you will understand why you bought your long-term care insurance, because that was a very important decision. And then how will you be able to use the insurance? And then I will be able to talk a little bit about CalPERS. So the first thing is, if you do have long-term care insurance, well done. Good for you. Long-term care insurance is one of those insurances that people either feel very strongly about and think it's great and have to have it, or people are super negative on it, just very unsure about whether they should do something like that. And there's many reasons for that. I mean, the whole thought of someone actually needing care for themselves is disturbing to some people, and they just really don't want to deal with it. Then the other thing is, the long-term care insurance industry has gone through so many changes. And if you have CalPERS, you understand what I'm talking about, rate increases, et cetera. And so it causes people to feel very negative about the decision that they made. But what I want to tell you, and I have long-term care insurance for myself as well. I bought a policy when I was 35. And 2 years after I bought my long-term care insurance policy, I had a small stroke. And so as a result of that, I am an uninsured person that if I wanted to get long-term care insurance, and I'm in my 50s right now, I couldn't get it. And so I just want to say, for those of you who have it, well done. And I hope you'll feel good about that decision after this particular presentation. The one thing that I do want to address is why this is such a huge issue. Why this is such a huge issue, there are many reasons, but one of the reasons is because of the changing family dynamics, right? I mean, I used to talk about how people would say to me when they would talk to me, I'm never going to a nursing home, my children will take care of me. I hardly hear that anymore. The reason I don't hear that anymore is because life is complicated, isn't it? And our children and even our grandchildren are experiencing things in their life that might prohibit them from being able to bring us into their home. In fact, this statistic right here, 80% of all long-term care is provided by family members still. And what does that mean? It just means that a lot of times kids, grandchildren, nieces, nephews, spouses are taking their loved ones to the doctor. They're looking over their medication. They're making sure that they're communicating with doctors. They're making sure that they have good food, just looking over the house, making sure that it's safe. And then stepping that up a little bit, some family members actually have to help with showering duties or putting, articles of clothing on. But in general, family members are still providing this service, and it's an unpaid service. And that presents problems for people, especially women who are primary caregivers. And if a woman is working, it's hard for them to provide that service. It is estimated, and this was in 2011, estimated by the Congressional Budget Office that amount of money that is quote unquote unseen providing care for loved ones as a family is about $277 billion. And so you can imagine if overnight we woke up tomorrow and the federal government said, we have had a change of heart. We are going to pay for long-term care for everybody, whatever you need in your home so that you're safe and you get what you need, we're going to do that. And you look at this figure right here and you can see why that's not going to happen. So long-term care, and if you have a policy, odds are your policy is going to pay because you need assistance with one of two things. Either you need assistance because you physically need somebody to actually help you put on clothing, shoes, socks, getting in and out of the shower, or you have a cognitive impairment. So those are the two reasons why insurance companies will at some point pay out benefits to their clients, because the client either needs assistance with their activities of daily living. And what those are would be bathing, dressing, toileting, transferring, ambulating, sometimes is included, eating, or continence care. And so you look at that list and you think, I can't imagine myself needing that type of thing. What does that look like? And what that looks like is this. An individual is needing knee replacements, but their doctor won't do it. Or they're just having, they have too many health problems, or they're choosing themselves not to go through the surgery because they just don't want to go through the rehab, or they need a hip replacement. And because those types of things are causing them pain, they stop doing things that they normally do, like getting up and walking, being mobile, getting in and out of the shower. So maybe they used to shower every other day. So now they're doing it once a week. That type of an individual technically would be considered not independent in their showering because their schedule is off. And what they normally would be doing, they're not doing anymore because they're accommodating for the fact that maybe they're afraid getting in and out of the shower. Their shower is not appropriate. Maybe they have a step over tub that they're just afraid to get in and out of. So they do it as little as possible. The other thing is dressing. What would that look like? I was at one of my clients' home just last week, and she has services 3 days a week in her home. She should have services more, but she doesn't want to. And I asked her, I said, how are you getting your shoes on when you don't have your support person here? Because she has such severe edema that she can't get her shoes on. And she said, I just don't go out. I just don't put them on, or I slip my slippers on, and I'll have somebody bring me a meal or whatnot. That type of a situation means that the person really isn't independent, although they have accommodated that situation or their life in such a way that they really do see themselves as independent. The other thing is ambulation or transferring. So a lot of the claims that we get are because individuals have been having a steady decline with their ambulation or their balance, and they've had multiple falls, or they've had a traumatic fall where they actually are declining in their health and their functionality. And once that happens, a lot of times our clients will just stop walking because they're afraid that they're going to fall. So when these things start happening, it means that it would be a really good idea for people who have long-term care insurance to evaluate, now is the time. and to have their family or their loved ones or whoever's in their life to help them set that up and to open a claim. The other reason why we file claims, and as I said, the long-term care continuum, so to speak, is the cognitive impairment. And we do get claims for cognitive impairment quite a lot. And generally, that means that a person needs help with their medication, their safety, companionship, whatnot. They're not driving anymore. They need transportation. Long-term care is provided in a couple of settings. Primary setting is home. The vast majority of claims, the vast majority of care is provided in the home. And this is really, as I've said so many times, a hidden issue. If you're in a neighborhood and not living in a retirement community, I'm going to use myself as an example. My husband and I live out in a rural area in Ramona, and we have a couple families on our street that are quite elderly and have significant issues, and they don't have care. Their families are helping them. And then we're in an area where there's not a lot of assisted living facilities. And so family members in our rural area have a tendency to stay in the home and take care of one another. When you get into areas that are a little more populated, the incidence of having individuals go into a retirement community is higher. So for example, if you stay in your home, the types of services like in my street where people are getting services, they have Meals on Wheels, they have transportation from the county. They may have a home care agency come in and do a few things during the week. They may also have a private caregiver that they found on care.com who comes in and provides services so that the care is provided so the loved one could go out and run errands, whatnot. Sometimes families need to go to an adult daycare facility. If you have long-term care insurance, most likely your insurance will pay for care in your home, in an adult daycare community. And generally that's for individuals who have a dementia and they can go to adult day all day and then come home. There's also residential care facilities like this down here. Residential care is also referred to as assisted living communities. It could also be dementia care facilities. When our clients get to a point where they're in their home, and let's say they're by themselves, their significant partner has passed away, and now they're by themselves. And let's say that person has dementia. Keeping somebody in that type of a setting 24 hours a day with private home care is very expensive if you do not have a family member. If you have a home care agency for someone in that situation, families pay between $700 to $800 a day for that type of care for 24 hours. When that happens, sometimes families decide it's best to move into an assisted living facility because now we can get 24-hour supervision and the expense is quite a bit less. Skilled nursing facilities also are where people do get long-term care. This right here, I just want to say really quick, most of our clients, the vast majority and other individuals will not go to a skilled nursing facility to receive long-term care unless they're on MEDICARE in California. In general, if you have private funds or you have long-term care insurance, you will be able to stay out of that type of a setting and you will be able to stay in a residential care or you'll be able to stay home. Just really quickly, the reason I want to talk about Medicare and home health is because a lot of times people will say, I don't know that I need long-term care insurance because my Medicare and my Medicare supplement says that it will pay for home health care. And in their mind, they think that means that I could have like a visiting angels or a comfort keepers type of person to come in and provide bathing and dressing. That is not true. So Medicare is a home health, it pays for home health services. And home health means this, it's skilled in nature, it's short-term, it's limited, and it could be hospice. It is not custodial in nature. And what that just means is that, like I explained earlier, if you need help with your activities of daily living, or you have a cognitive impairment, that means you need custodial care. Medicare will not pay for that. They will pay for physical therapy or occupational therapy, which is terrific, but they won't pay for that lower level of support. The other thing is sometimes people say, and I don't need to buy long-term care insurance because I have 100 days coverage. See here, my policy says I have 100 days coverage in a skilled nursing facility. So this is how that works. You have to be in a hospital generally 3 days, 4th day discharge, then admitted to a skilled nursing facility. Once you're there, under those circumstances, the average Medicare stay pay is 22.5 days. So what that means is for individuals, for example, who are caring for a loved one, let's say who has dementia, and they think, you know, we just got to get them into the hospital. They got to be there for 3 days so that they can go to the nursing home. And if that happens, then Medicare will pay. That will not happen. It's difficult to get people into a hospital, as you probably know, let alone stay there for 3 days, 4th day discharge. So sometimes what happens is family members wait until something happens so that they can get them into the hospital, and then they can get them into the nursing home for the in-between kind of holding pattern until they figure out, now what are we going to do? That is paid for by Medicare, and also long-term care insurance will pay for that, but it's short-term in nature. So here, I'm going to give you some averages. So this is 2021, and I took it out 35 years. There, as I said, these areas where you're likely to receive long-term care is in the home. You'll need homemaker services or a home health aide, or adult day services, or in an assisted living, or in a nursing home. Now let's look at the numbers. On average today, a person will pay $73,000 in general. This is for California. This would buy a person today between 4 to 6 hours of care a day. Okay. The average cost of care for home care agency right now on the low side is $32 an hour. On the high side is $52. And we have home care agencies that fall into that range. The cost of home care has just exploded. And part of the reason is because of COVID. There's other reasons too. If you have had to receive care in your home, or you've helped a parent or a loved one who needs home care, you know how really difficult that can be to find a really good professional, vetted agency that will send the same person to your home and who you can develop a relationship with. Part of the reason why that is difficult today is because the labor force is lower, and finding people who will provide this type of service is difficult. And so some home care agencies, as a result of that, have gone to what's called minimum staffing amounts. And that means that if you want to have somebody into your home and you love this home care agency, they will require that you have 6 hours of care a day, at least 4 days a week, which is 24 hours in a week. And that's hard for some people, because you can imagine if you are in your home and you really need somebody just to come and do the showering, your dressing, they can be in and they can be out. Having somebody in your home for 6 hours is tough. And so right now, what we're helping our clients with is to find the home care agency that will fit with what's going on in their life, that will be able to staff for their situation, and not charge an arm and a leg, so to speak. Some agencies will charge $60 an hour if you want them for 2 hours. And sometimes our clients do that. They say, I only want somebody here a couple hours, where you're going to pay more money for that. So here's the amount of money in general you're going to spend a year for the basic home care. And as you can see, the amount in general, what we're seeing is the inflated cost of home care. The inflated cost of long-term care is between 2.9 to 4%. That's what they're estimating. So let's bounce down here to adult day. That's a huge difference, right? The cost of adult day in 2021 versus home care is quite low. Now, why is this? Because adult day is less expensive. And for 8 hours or for 6 hours, you can have a loved one in an adult daycare community and receive enrichment programs and whatnot. And it's very reasonably priced. But if you had the same amount of services in your home, you're going to be spending over $70,000 a year. Assisted living facilities are also referred to as residential care facilities for the elderly or dementia memory care facilities. This amount right here, $63,000 a year, is low. The reason why the range is such is because there are communities called board and care facilities, and some board and care facilities are very inexpensive. Then you have the other end of the spectrum, which might be a specialty memory care boutique community that is $20,000 a month. In general, most of our clients spend between $5,000 to $9,000 a month for assisted living care, depending on how much physical support that they need. And then here you have the amount for skilled nursing. Again, it's just so expensive. Now, your long-term care insurance most likely looks like this. It's a comprehensive policy. It's like a piggy bank. You've paid into this for how many years? And each year that piggy bank is expanding because it's growing in value in general. The reason being is because when you bought your long-term care insurance and when you look at buying long-term care insurance, you're going to add an inflation rider on so that the original amount that you did purchase is going to grow because you're going to carry your policy for a long period of time. So when I bought my long-term care insurance when I was in my 30s, and as I said, I'm in my 50s, I have 20 years growth on that policy now. So my piggy bank is doubled from what it was when I first bought it. And in the event that you need care, what that means is you are going to tap into your pool value, and most likely you'll be at home. You're going to start receiving care at home first. Well, how much money are you going to get at your home? The amount of money you're going to get at your home depends on your schedule page. And sometimes people, after listening to my presentation, will ask me to review their policy, which I'm happy to do. And I will ask you, I need to see your schedule page, because what that does is it shows me what you bought. It shows me if it's been growing. And then I can tell you how much money you have in your policy. So let's say you're like most people and you buy long-term care insurance, or you're thinking about buying long-term care insurance. You're going to start in your home most likely to receive services. And maybe you just want to put a toe in the water. You only need a little bit of support, and you have a spouse at home who's also helping with your care needs. And so you're only spending, say, $3,000 a month out of your piggy bank every month. So the insurance company is going to pay that to you, and your value, your piggy bank, is going to go down, slow. Sometimes it is required that an individual needs lots of care, and they're going to pull the full dollar amount out of that piggy bank every single month. So what's important for you to know is when you bought your policy, or when you're going to buy a policy, these 4 things. How much is this going to pay for me per month for my care? Where is it going to pay for my care? Is it at home and in a facility? Yes or no? Odds are, if you have a policy, it's in any setting. And certainly if you buy a policy now, it will be comprehensive, which it pays for care anywhere. Number 2, how long is this going to pay for my care? Well, that kind of means, how big is my piggy bank? When people buy long-term care insurance today, they usually purchase a piggy bank amount that will pay about 3 to 5 years for their long-term care, because that's the average claim. Sometimes people who have cognitive impairment issues in their family, or they've had an experience with a family member that has lived for a really long time needing care, they might want a longer pool, like a 10-year pool duration or 10-year piggy bank, for example. But those are the things that you will look at if you're intending to buy long-term care insurance. And of course, you know that if you buy more, your premium is going to be high. If you have a long-term care insurance policy now, odds are you've had a rate increase. And those rate increases, every time you get a rate increase, they come back to you and say, hey, do you want to reduce your piggy bank? How would you like to reduce your piggy bank? Would you like to take less money per month? Would you like to take less total pool value? Would you like to take off your inflation rider? And those are the things that a lot of times people ask our help in, because it's confusing and complex, and it's a huge decision. Sometimes people buy what's called hybrid policies. Okay, so the piggy bank thing I forgot to mention, you pay that premium every year. And let's say that you just died and you didn't need any long-term care. What happens to all that money? Well, there is no money, because the insurance company terminates the policy, and there's no value to be paid out to your family members. And those premiums that you paid in stay with the insurance company. Well, years ago, 10, 15 years ago, the insurance industry developed a long-term care product called a hybrid. And the reason they did this is because people hated the idea that, gosh, I'm going to pay on my policy for 20 years. I may never use it. Now, that really makes no sense, because that's what insurance is. And this insurance is really no different than your health insurance or your automobile, et cetera, et cetera. However, as I said before, long-term care insurance is just a different thing. People feel strongly about it. And what they feel strongly about is, if I'm going to be spending this kind of money, I really would like to get something out of it. And so insurers developed what's called a hybrid. And a hybrid policy means this: you're going to pay your premium, this little bucket right here. You're going to pay your premium. And that premium looks like this. It's a one-shot deal. Boom. And you're putting lots of money. When I say lots of money, I'm talking a single premium deposit between $50,000 to maybe $150,000 that a person transfers from one account into this life insurance policy. And for that, they get 3 different types of avenues to get their money back. The first avenue is they can get all their money back. So let's say a person buys this hybrid, and 3 years later, some lost uncle sends them money, and they no longer need to have any insurance because they're self-insured. Okay, so that means this type of a person could say, you know, that policy I bought, I don't think I need that anymore. You can get your money back with a little bit of interest, not a lot, but a little. Or if you passed away and you did not need long-term care, there's a death benefit. So your beneficiaries would receive almost double, a little less than double of what you put in. So let's say you put in $100,000. Your death benefit is going to be about $200,000, depending on your age. So that's cool. So you're going to get your money back, surrender, or if you pass away, your heirs are going to get that benefit. So your premium that you put into here, it's just holding somewhere. It's just being held. Or if you need long-term care, and this is why you buy this, right? So if you need long-term care, what that means is the pool that you get is actually bigger. So the insurance company is going to leverage that bucket premium that you originally put in, and they're going to leverage it, and it's going to be worth 3 to 4 times the amount that you originally put in. So in the event that you need long-term care, they're going to pay you just like they would regular long-term care insurance. They're going to pay you for your care, and it's going to draw down, and they're just going to pay for your care until that bucket is empty. People love this. They love it because they think, I'm getting something back that I understand, that I like. The downside to something like this, of course, is you have to have the amount of money to get this thing cooking so that it gives you enough long-term care benefit. The other thing that's kind of cool about the hybrid is that they do underwrite people a little bit differently than the traditional. And sometimes our clients that have kind of weird health issues that would cause them to be uninsurable with traditional long-term care, we usually can get them a hybrid policy. All right. So just to recap really quick, and we're doing good on our time. You're going to buy long-term care insurance, or you already have long-term care insurance. What are the 4 things that you need to know about what you have or what you're going to buy? Number 1, how much is that going to pay for you per month for your care? Is it going to pay in your home and in a facility? Yes or no? Number 2, how long is it going to pay for your care? You have to determine your pool maximum. Most people buy a 3 to a 5 year duration. Back in the day, people would buy policies that were unlimited. And so maybe you have an unlimited policy if you have a long-term care insurance policy. If you don't know what you have, or if you've lost your policy, you must get another one, and you need to keep it in your house in a folder with your trust or with your other important documents. Do not keep this in a bank. And if you can't find it, get on the phone with your insurance company and have them mail you a duplicate. Number 3, what kind of an inflation rider do you have? Most people today are going to buy a 2 or a 3% compounded inflation rider. Some people who have old policies have a 5% compounded inflation rider, and that's why premiums are going up. But that's really sweet because that grows that benefit so quickly. Number 4, and we have not talked about this very much. It's a little bit of a complicated concept, but policies for long-term care coverage have what's called a deductible, but it's called an elimination period, which is, I don't like that because it's so confusing. But what that means is there's a certain number of days that are eliminated from you getting benefit. Most people have a 90-day elimination or 90-day deductible, 90-day waiting period. Those 3 words are used in various policy forms. Again, most people will have a 90-day deductible. It's very important that you understand what deductible you have, and not only what deductible you have, but how the heck do they measure it? How do they look at that deductible? Don't count on Medicare to pay for those 90 days. Do not buy a long-term care policy assuming Medicare is going to pay for those 90 days. It's not going to happen. You're going to be out of pocket. Whatever your deductible is, you're going to be out of pocket for that. So it's important you know what that is. So here's some prices. This is today. So what I did was I took a sample of a $5,000 a month benefit. So remember I said, how much is this thing going to pay you per month? So it's going to pay you $5,000 a month. And this is a $200,000 pool maximum. That means that in today's dollars, it's worth, that piggy bank is $200,000, okay? And it has a 3% compounded inflation rider, which means that that benefit is going to go up at a 3% compounded the rest of your life, even while you're on claim. And it has a 90-day deductible. I like deductibles that are only calendar days. Most policies that you're going to look at are calendar days, which just means from the time that you start services, 90 days has to pass, but you could have a spouse caring for you during that time. Some policies require you actually have a professional person taking care of you for 90 days. We can talk about that. If you have a policy, I'll tell you which yours is. So let's look at the ages. Age 55, male, female. Look at that. For the benefit here that I talked about, a male will pay $2,271, and these are average prices. There are several companies that you can look at today. Look at what a female will pay, $3,863 at age 55. These premiums are subject to increase. They're probably not subject to the increases if you have long-term care insurance now that you're experiencing now. However, they could go up. Age 60 for males, $2,591 for females. You're knocking at the door of $4,500 a year. Age 65. Here's the prices, and age 70. Now, why do I show this? Why is this important? for two reasons. A lot of times when I give these programs, there are people who have long-term care insurance, maybe with Genworth or CalPERS, and they've had a rate increase and they're in their 70s and they think that their policy is way overpriced. And then I show them this and they realize, oh, okay, mine is not way overpriced. Mine was underpriced and now they're catching up to what it should be. Hybrid. It's a little bit more tricky. However, what I did was I wanted to look and see, in general, if I were to put between $125,000 to $150,000 into that life insurance policy for that type of a transfer of funds, you will be receiving in today's dollars $6,000 a month in a benefit. And your pool maximum, this is husbands and wives or partners shared. Well, can you buy a policy and not have a partner? Of course, it just means it's cut in half. Or you could have a $600,000 pool value, but I wanted to keep the example similar. Spouses, partners. So the partners share this pool value, $600,000. So each $300,000 per person, for example. You've got your inflation rider of 3% and your 90-day deductible. Now, you first have to put in that single premium deposit, and that's sitting in the life insurance policy. It's just sitting there kind of cooking. Each year, you also pay a premium on some policies, and here's the premium. At age 55, the total premium is $29. At age 60, the total premium is $31.55. At age 65, the combined premium is a little over $4,000. Now let me just toggle back. I want to show you something. Age 60 for traditional, look at the difference. $2,591, almost $2,600, and almost $4,500 for traditional husband and wife versus this combined. How is that? How can they do that? They can do it because of that single premium deposit that you put in. So if you have looked at continuing care retirement communities, this is a similar concept. You put in a chunk of change and it buys down the cost of your care. This is similar. You put in a single premium deposit and it buys down what you're going to pay for your long-term care insurance in the guts of that policy. I talked about this a little bit earlier, so I'm not going to go on a whole lot. Triggering your policy, and this is an important thing that I want you really to think about. One of the things that has been somewhat disturbing to me, and I speak about it every time I give these programs, is that because of these premiums going up on some of these policies like Genworth or CalPERS or whatnot, policyholders get incredibly ticked off, which I can understand because I myself got a rate increase. They get angry. Then when they see the company offering them a way out, they want to take it. They want to get rid of their policy, take the cash. And so I walk people through that. And a lot of times as I'm walking them through that, I realize they actually should be on claim. They actually should be filing a claim because they're ill or they are already getting help and they don't even realize they're getting help. I had a client who moved into an assisted living facility, Meadowbrook Village down over here in Escondido. And she called me because she had a rate increase. And she said, I cannot afford this. I'm going to drop it. And I said, please don't do that. Let me see if I can help you. I'll come and see you. And she said, I've moved. My new address is such and such. And I said, wait a second. That's an assisted living facility. Yes, she said, I moved in here 2 years ago. And I said, oh my gosh, well, I definitely need to come see you. I went to see her. She was in a wheelchair. She was getting showering and dressing support, but in her mind, because she was not bedridden and because she was able to assist the staff, assist her, she could stand up and get into the shower. They were just there making sure she didn't fall. She thought that she was independent in her activities of daily living. And so she didn't even cross her mind to file a claim. So we filed a claim, got her benefits approved, backdated, and guess what? When you go on claim, most of your contracts stop your premium payment. So she went on claim, she started receiving benefits, and then her premium stopped. And so this is why I tell people it's so very important, even if you're thinking, I can't afford to pay this rate increase, or I'm so angry, you need to look at your situation, look at even if your health has changed, look at if you have a current diagnosis of something new, and really, really not make any changes to your long-term care insurance, because in the event that you do file a claim, once you start getting your benefits, you won't be paying that premium anymore. And so the rate increases are not going to be an issue for you. Who should have long-term care insurance? Women, 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 women. A person who is living as a single individual in the community. And that's obviously, it makes sense as to why I would say that. There are a lot of people in the community that are at such risk. And unless that person is not competent, there's absolutely nothing their family members or loved ones can do about them making choices that secure their safety. But single individuals are so at risk, especially if they're falling and whatnot. So once a person exhibits those types of things, they cannot get long-term care insurance, right? You have to get it before anything starts happening to you. The other type of person who should have long-term care insurance is someone who has limited family support. So I shared this in my a talk that I did a little bit earlier. My husband and I started the process of building an ADU for my parents. Literally, we've been doing this for the last year and a half. And with all the permitting and everything, which we thought was going to be super easy, it's not simple, but we're building an ADU and we're moving my parents from Iowa, and they just had a tornado go through their neighborhood last week. Crazy, crazy, crazy. They were one of those unfortunate people. Thankfully, everybody's safe, but we want to get them out of the cold, the bad weather, and move them close to us because they're getting older and they're needing some more support. My parents do not have long-term care insurance, and so they're going to depend on their family, and that's why my husband and I are doing this. If you have a family history of dementia, you should have long-term care insurance. If you have a family history of Parkinson's, neurocognitive disorders, anything like that, you should be getting a policy. If you're between ages of 50 and 75, you're probably still a good candidate. It's harder to get people in their late 60s approved for long-term care insurance, but if you're in good health, you can get it. It's going to cost you a small fortune. But if you would prefer to look at a hybrid policy, there's a way that you can get a good policy and not just make, that it's ridiculous and it doesn't make sense financially. My contact information is right here. I am much easier to reach in an email because I'm on the phone literally all day long. It's hard to catch me unless you have an appointment with me, but I check my email all the time. You can shoot me an email with your schedule page if you have any questions, and I am more than happy to look it over for you. And now we get to answer some questions. Hopefully there's some questions.
Thank you so much, Linda. This is very, very useful. I don't see any questions in the chat, but I can go ahead and monitor the raised hands function. If anyone wants to raise their hand or unmute themselves to ask a question, please feel free to do so. And this was quite a lot of information, so I'll let people get their questions in as well.
I think Eileen might have a question.
Yes, Eileen, if you could unmute yourself.
No. Am I unmuted now?
I can hear you.
Good, thank you. I just wondered if you wanted to comment on the new information that came out about the CalPERS settlement. The terms have been changed, and we originally signed up to get our money back, and then we had second thoughts. It was too late. We'd already signed up, but now I believe we have a second opportunity to stay in because the terms have changed.
That's right. Yes. Yay. I'm so glad. I'm so glad you didn't get out. So I'm looking at a letter, and it appears as though they're going to be sending letters out starting April 7th. And it looks like they're going to give you a couple months to make a decision. You're going to have two choices. And again, we'll see the paperwork when it comes out. Here are the two choices. You can surrender in exchange for a payout. You can surrender it and just get out of it. Or you can keep it. And it looks like there's going to be a moratorium on future rate increases for a short period of time. And they're going to give you some cash also. I will just say across the board, no matter what, in general, do not cash out your policy. Keep it. Keep your policy. And if they're going to give you a little bit of cash, that's great. But I want to see the terms, because they may give you cash and they may reduce something in your contract. We don't know. So it's just going to be important to keep an eye on that. It looks like it's possible, again, and I don't know because it doesn't say, but it says that there's a moratorium on the increases to a certain period, which makes me think that they can raise premiums again, and they probably will start picking that up again, which is really discouraging, and which is why people just want to get out of it. If you are under 65 and in very good, let me rephrase that. If you're under 70 and in very good health, then you should think about getting out of it. But you do not get out of it until you have something secured in place. So for example, someone like this who wants to get out of it and they get that cash, they could put that into a hybrid policy and they could get a hybrid policy, put the cash that they get from CalPERS into that thing, and they could get another long-term care insurance. But getting a new policy takes between 4 to 6 weeks. And so we always tell people, try and make this decision as soon as possible to give yourself a big ramp, make your decision, apply for a new policy, and then cash out. Does that make sense?
Yes, thank you.
Okay, you're welcome.
Oh, I did have one other question, if I may. How likely is it that CalPERS is going to still be in existence when we might need it? Is it going to go on forever, or do you think it could fold?
Well, that's a very good question. And of course, I don't know the answer totally. However, I can give you just some background and understanding. They have stopped selling policies. So at some point, everybody's going to be using, and then it's going to be over, using their benefits, and then it's going to be over. Depending on who gets out of the contract based on this new settlement, that may shore up the time frame and the fund at which benefits will be paid. That's a good thing. But at the end of the day, I do not believe that there's any likelihood that this thing is going to go belly up, bankrupt, and people are going to be left with an empty contract. I cannot imagine that happening just in our political climate and our climate now. I just can't imagine that happening. Again, I think differently about these types of things. So that remains to be seen. And I do know that that is very concerning and risky for people. But I just don't think that that should be factored into whether people keep or get rid of their policies.
Thank you so very much.
You're welcome.
Are there other questions from our members? Anyone who would like to ask? I think you gave us all quite a informative presentation, so you covered all the points needed, Linda.
I did. Thank you, Vania. I appreciate it. And I know that you put this information on your website, so anybody can go back on and look at it. And if you want to email me and you want the slides, I'll be happy to give them to you. Just reach out.
That's perfect. Thank you so much. Yes, we will have this recording on our YouTube channel, and any slides you send over or materials, we'll go ahead and share with everyone, as well as your contact information.
Okay, I will do that as soon as we wrap it up.
Great. Thank you so much, everyone.
All right,
Have a
you
nice
guys, take care. Have a good week.
Thank you.
Bye-bye. Thank you.
Bye-bye.
Bye-bye.